In America, being financially responsible is supposed to protect you. Work hard, save money, avoid unnecessary debt, plan for the future. That's the promise. But reality tells a different story. Millions of Americans did everything right and still lost everything. They didn't gamble, they didn't overspend, they didn't chase luxury, they followed the rules. And that's exactly why they failed. Because the American financial system was never designed to reward responsibility. It was designed to reward participation. From the moment you earn your first dollar, the system begins training you not to protect money, but to move it. Savings slow the system. Spending fuels it. So responsibility becomes a liability. In the 1950s, America rebuilt itself on consumption. Factories needed buyers. Banks needed borrowers. Growth required constant demand. The solution was simple: turn citizens into consumers. Credit wasn't created to help people. It was created to keep the economy moving even when wages stopped rising. By the 1970s, something dangerous happened. Productivity kept increasing but wages froze. People were working more, producing more, yet earning almost the same. Instead of fixing wages, the system introduced plastic. Credit cards didn't feel like debt. They felt like freedom by now. Pay later, worry later. Financial responsibility used to mean saving before buying. Now it meant managing monthly payments. A $20,000 car didn't look expensive when broken into $399 per month. A $3,000 phone felt normal at $89 per month. Prices disappeared. Only payments remained. And when prices disappear, reality disappears with them. Banks loved responsible people, but not because they saved, because responsible people paid on time. Late fees came from the reckless, but interest came from the disciplined. The best customer was not the spender who defaulted. It was the responsible borrower who never escaped. By the 1990s, debt wasn't a failure anymore. It was a requirement. No credit history meant no apartment. No loan meant no car. No debt meant no access. Responsibility without debt became suspicious. Then came credit scores, a single number that claimed to measure trust, but really measured obedience. Did you borrow? Did you repay? Did you stay inside the system? Saving money didn't raise your score. Avoiding debt didn't help. Only participation mattered. You could live below your means, avoid loans, pay in cash and still be punished. Meanwhile, someone buried in debt but paying minimums was rewarded. The system didn't ask if you were safe. It asked if you were useful. By the early 2000s, Americans were told to be responsible homeowners. Rent is wasting money, they said. Buy a house, build equity. Banks lowered standards. Loans were handed out like candy. People trusted the system because responsibility was promised protection. Then 2008 happened. Responsible families lost homes they could afford. Careful workers lost jobs they depended on. Savers watched retirement accounts collapse overnight. Banks were rescued. People were not. And the lesson was clear but rarely spoken. Responsibility does not guarantee safety in a system built on risk. After the crash, Americans tried to be careful again. They saved more, spent less, and the economy panicked because when people act responsibly, growth slows. Markets hate caution. So interest rates were crushed to zero. Saving became pointless. Inflation quietly punished those who waited. Once again, responsibility was the wrong move. Young Americans learned this fast. College degrees were sold as responsible investments. But tuition exploded faster than wages. Students graduated disciplined and trapped. Monthly loan payments replaced opportunity. Choices disappeared before adulthood began. Working harder didn't fix it. Budgeting didn't fix it. Because this wasn't a personal failure. It was structural, and it was intentional. In America, money is not a tool for security. It is a lever of control. Financial responsibility threatens that control. A population with savings can walk away. A population in debt cannot. Debt keeps people trapped in jobs they hate. It keeps them showing up every morning. It keeps them afraid to speak, afraid to stop, afraid to fall behind. That fear is not a side effect, it is the fuel. That is why inflation is not treated like an emergency. Because inflation punishes savers first. Your cash loses value quietly. No warning, no headline, just erosion. At the same time, assets rise. Homes, stocks, investments. Those who already own get richer without effort. Those who wait, who plan, who save, fall further behind every year. Responsible behavior becomes expensive. You are told to be patient, but patience is taxed. Speed is rewarded. Even retirement, once the final reward for discipline, has been transformed. Pensions promised certainty, so they were removed. In their place came market exposure. Risk was quietly shifted. From corporations to individuals, from institutions to workers. You were told to invest responsibly, diversify, think long-term. But when markets crash, it is never a system failure. It is volatility. It is a cycle. It is unfortunate timing. When markets rise, success is credited to discipline. When they collapse, blame disappears. Either way, you carry the consequences. Healthcare follows the same rule. Save your money, plan ahead, be responsible. Then one illness arrives, one accident, one diagnosis, and decades of discipline are erased in a single invoice. Medical debt is now the leading cause of bankruptcy in America. Not luxury, not gambling, not recklessness. Responsibility destroyed by design. The system tells you to build an emergency fund. 3 months, 6 months, a year. But modern emergencies cost more than most people can save in a decade. And when savings fail, credit is already there, waiting, smiling, ready, always waiting. Responsibility keeps you alive. Debt keeps you owned. Even housing now punishes caution. Those who waited for stability were priced out. Those who rushed in barely survived. Interest rates rose, payments exploded, stress became permanent. The market rewarded timing, not wisdom. And timing is never taught, because timing creates winners. Wisdom creates independence. So Americans blame themselves. I should have worked harder. I should have budgeted better. I should have known that shame is powerful because shame keeps people quiet. Shame turns structural failure into personal guilt. It hides the truth. The truth is uncomfortable. The system does not collapse when people are irresponsible. It collapses when people stop borrowing. That is why bailouts are instant, but relief is delayed. That is why banks are rescued overnight, but wages are debated for years. That is why corporations are stabilized, but families are evaluated. That is why the language is always personal. Manage your money better. Cut expenses, hustle more. Never the real question. Never. Why does survival require debt? Being financially responsible in America doesn't fail because people are wrong. It fails because responsibility threatens a system addicted to leverage. A system built on borrowed money, borrowed time, borrowed stability. The system does not want you stable. Stability creates options. It wants you predictable, just responsible enough to keep paying, just stressed enough to keep working, just hopeful enough to not rebel. And as long as people believe failure is personal, the system remains invisible. That is the real reason responsibility fails. Not because people don't try, but because trying was never the goal.